If markets are truly efficient, then every stock is always perfectly priced. So why do thousands of hedge funds charge billions in fees trying to beat the market? This is the central paradox of modern finance. The efficient market hypothesis is the most debated, most tested, and most controversial idea in all of economics. Eugene Fama proposed the efficient market hypothesis in 1970. The core idea is simple. Asset prices fully reflect all available information. You cannot consistently beat the market because the market already knows everything you know. When new information arrives, an earnings report, a Fed decision, a geopolitical event, prices adjust almost instantly. By the time you react, the price has already moved. EMH comes in three forms, each progressively stronger. The weak form says prices already reflect all past trading data. Technical analysis, reading charts and patterns, should be useless. The semi-strong form says prices reflect all publicly available information, not just past prices, but earnings reports, news, and financial statements. Fundamental analysis should not give you an edge. The strong form goes even further. Prices reflect AL information, including insider knowledge. Even corporate insiders cannot beat the market. Almost nobody believes this version holds perfectly. What does the evidence say in favor of EMH? First, stock prices follow a random walk. Tomorrow's price change is essentially unpredictable from today's data. The path of prices looks indistinguishable from a random process. Second, and perhaps most damning for active managers, over any 15-year period, roughly 90% of professional fund managers fail to beat a simple index fund. The market is incredibly hard to beat consistently. But the evidence against EMH is equally compelling. Markets have produced spectacular bubbles. The dot-com bubble, the housing crisis, where prices clearly deviated from fundamental value for years. Researchers have also documented persistent anomalies, the momentum effect, where recent winners keep winning, and the value premium, where cheap stocks outperform expensive ones. These shouldn't exist in efficient markets. There is a deep logical problem called the joint hypothesis problem. We can never truly test EMH alone because any test requires an asset pricing model. If we find abnormal returns, is the market inefficient, or is our model of fair value wrong? This is why Fama himself, who proposed EMH, says it can never be definitively proven or disproven. The hypothesis is fundamentally untestable in isolation. Behavioral finance mounted the strongest challenge to EMH. Kahneman and Tversky showed that investors are not the rational agents that efficient markets require. We suffer from overconfidence, loss aversion, and herd behavior. These biases create predictable patterns in prices. Investors overreact to dramatic news and underreact to slow-moving trends. This systematic irrationality opens the door for savvy investors to find edges. Perhaps the most elegant critique came from Grossman and Stiglitz in 1980. Their paradox is devastating. If markets were perfectly efficient, no one would have any incentive to gather information. But if no one gathers information, prices cannot be efficient. Perfect efficiency is a logical impossibility. Markets must be inefficient enough to compensate information gatherers for their costs. The equilibrium is one of near efficiency. Prices are mostly right, but not perfectly right. So what does this mean for you as an investor? The practical implication is clear. For most people, low-cost index funds are the best choice. You get market returns minus tiny fees. Trying to beat the market is a negative-sum game after costs. But the market is not perfectly efficient. Edges exist. They are just small, expensive to find, and they tend to disappear once discovered. The few who consistently beat the market earn that alpha through genuine skill, better technology, or informational advantages. The truth about efficient markets lies somewhere in the middle. Markets are efficient enough that most people should not try to beat them. But they are inefficient enough that the effort to find mispricings keeps them approximately right. It is a beautiful self-correcting system.